Good morning, folks. If you could all give me a audio check that are already present. After I get a 5x5 on Twitter, then I'll send the link because I don't want to send everybody prematurely without knowing the audio is good. I'm trying the ultra low latency setting today on YouTube, so you should be able to know what I'm thinking before I say it. You wish, right? All right, awesome, awesome, awesome. Just bear with me 1 second, okay, folks? Good grief, there's already 3,000 people watching. I haven't even started yet. All right, I'm just going to grab a quick bottle of water and then we'll begin. All right, folks. Good morning, and good morning. So we are looking at the S&P. Upper left-hand corner is a hourly chart. Lower left-hand corner is a 15-minute time frame. And over in the large right-hand side, it's presently set to 2 minutes, which I'm going to toggle now to 5. Before we get into this, I want you to slow your roll this morning, okay? I'm going to give you the reasons why we have to be very cautious this morning, but we'll be here until about 10:30, maybe quarter of 11. Now, we've had a holiday this week, which interrupted the normal ebb and flow of price, sentiment, trading, speculation, order entry. Just a lot of folks like to sit on their hands like me, and we don't want to touch those partial days where they trade 9:30 to 12. There was trading on Monday, but it's so abbreviated in terms of the time it's allowed to move around. It's important not to feel like you have to be part of that. Whenever we have a holiday, this is what you're going to be writing in your notes this morning if you haven't already decided to do so. I'm prompting you to do it now. On the heels of any holiday that impacts trading normal hours, anytime that occurs, the very next trading session, the morning is very, very, very low probability, meaning that it can be choppy initially, or the entire morning session could be a wash, meaning that we may not get a clean entry. We may not get anything that makes any real technical sense to be a part of it, but it's beneficial for you to be observing it. Now here's the thing that you want to know, if this morning is nothing that brings my attention to a specific setup, a draw on liquidity that makes more sense than I'm expecting, then I'll join you all in the afternoon session today. So you'll get potentially two. So don't be upset if there's nothing clean this morning. Now, pre-market, I shared a trade with you. I was trying to get in sync with what the market was likely to do this morning. And because, remember what I said earlier, not earlier today, but last week and such, and in Twitter spaces, if I believe, if my analysis, if my experience, or I just get a hunch, I'm human, that I feel that the morning session is going to be problematic for me. If it's going to be choppy, if it's going to be listless, aimless, low liquidity run signatures are probably not going to be in favor, then what do I likely do? I like to look for a 7 o'clock in the morning to 8:30 in that time vicinity. I look for an opportunity to take a trade there. And what that does, number one, it removes the necessity for me to do what when 9:30 comes? Push the button, chase something that may or may not be there. Whereas pre-market, because I understand that if those conditions are, in fact, what we're going to encounter this morning, which is problematic price action. Remember, while you're being mentored by me, it's not enough for me to sit here and say, here's the best fair value gap to buy or sell in. Here's the order block to buy in. Here's the breaker. Here's the draw on liquidity. You need to know where to draw the line and say, I'm not going to step foot in this just yet because it doesn't look safe. Now, we never have an opportunity where the market's 100% risk-free. But there are times when the probabilities are so shifted in our favor that it's almost a crime not to participate. That's what I'm trying to teach you to identify, these low resistance liquidity run signatures and environments, these market profiles that allow for very clean price runs. We don't have that this morning, okay? And I'm going to quickly go over why that's the case, okay? Number one, in your notes, you want to have a rough draft of all of your notes this morning, and then once you're done today, refine them and then add them to your journal, okay? Because there's going to be a lot of truncated statements because of me watching price action, and I'll kind of give you a summary at the end. But going into it, this is why I elect to tell you and forewarn you that we're going to be probably in a very difficult morning session. If you look at the dollar index, the dollar index is all over the place this morning. It's choppy, it's range bound, and then, and I'm referring to a 15-minute time frame if you're looking at the dollar index. You can find that on TradingView with DXY, that symbol, and the 15-minute time frame. It's free. You don't have to subscribe to anything to get that information. If you look at what we've done, we have a range essentially around 103.87, if you want to call it that low, and then the high of 104.26 or thereabouts. So we're inside that range. It's range bound. It's listless trading. Over on euro dollar, we've had slightly lower prices, but we're still in a consolidation, much like we had in dollar index, as you would expect. But then look what we have here in British pound. Pound dollar on its 15-minute chart, we've had a nice acceleration to the upside after reaching below the 119.90 level. So we reached as far as 121.30. That run, the fact that we're on the heels of a holiday and we don't have a lot of clarity in terms of the ES, what it wants to reach for. And I'm going to go and show you my new week opening gap template so that we can get a feel for what might be unfolding. And then we'll go into the details with ES and what we're going to be focusing on. Give me 1 second. All right, so you should be seeing the new week opening gap template for ES. And let me get to my chart so I can follow along with my own jawboning here. All right, so this is an hourly chart. This right here, now I know I don't have a way of highlighting my cursor, but you should be able to see it right here, about midpoint of the chart. Directly underneath my cursor, there, you're going to see a small little segment right there. That is this week's new week opening gap. Okay, really, really small. Then I have this one here. So I want to kind of like scroll through and let you see the levels, and your homework assignment is to find out where they're anchored to And then this evening I'll give you a review as to where they actually are anchored from. So I'll make the chart a little bit taller so you can see the levels. Okay, and what you want to have in mind when you have these on your chart is think of them as dynamic support and resistance. Now we're trading down here, real time. For those that are watching that have the benefit of having real-time data, try to give me a latency. Right now, looking at my stream versus your data, how far away are we in terms of price? Is it kind of close? Because I'm using the smallest latency setting for YouTube streaming. A lot of people complaining, you have a delay. That means I'm probably doing something wrong or sneaking something in there, right? So 4020, 4019 and a quarter, 4018 and a quarter. There should be one more down here. Yeah. 3988.50, 3987.75, and 3987 even. Okay, so that way you have that. And the other ones you already know about because we've been walking forward with it. So there's the ones that we're actually having on our charts. If you haven't had those on your charts, then you need to calibrate your charts and show those levels as I've shown here, because that's what's on mine. On TradingView, you can create little templates and save them. I save mine as New Week Opening Gap, NWOG, and then anytime I want to refer to it, it allows me to go to this chart with no other additional annotations. Let's go back to the ES chart. All right, we're going to start in a couple minutes because the session's about to begin. Just want to flash the disclaimer once more, just in case you didn't see it when you came here. This is not a signal service. Do not push a button on anything I'm saying. It's live tape reading. Okay, it's help you get accustomed to reading real-time price data, which is an essential step before you even consider demo trading, and certainly before live trading. So we have gap opening lower. So we'll be looking for a reason to want to pursue a retracement back into the overnight price action. I'm not suggesting we're creating a low to go straight to the moon or anything like that, but there is a gap between, if you look at your electronic trading hours tab, that's what's being shown here. If you click on regular, we're a good deal away. And TradingView is not going to update and show for whatever reason. They didn't want to populate the chart on my end for yesterday's abbreviated session. So just know that we will have a very choppy, likely morning session. So the opening range, first 30 minutes of trading from 9:30 to 10 o'clock, we're basically observing, trying not to do too much, not having any kind of impulse to want to chase anything. Even if it tears off and starts to run away, these conditions are the ones that you want to sit still and let it run without you. It's okay. These types of moves, they're 50-50. You don't know. And you want to try to trade in conditions that are very, very favorable, that low resistance liquidity run signatures will reside in. We don't have that this morning. But it's beneficial for you to learn this, because if you understand what we're studying and looking at, it will prevent, hopefully by experience and being in it, not jumping in blindly when you start trading with your quote-unquote funded accounts, or if you ever decide to trade with live account funding. So far, dollar is not showing any kind of willingness to want to leave its range this morning. And again, this is all based on what I was mentioning about the holidays. Take this up to a 60-minute. All right, so we have buy side resting around 40.90. We also have another pool of buy side liquidity resting at 40.73 even. We've already worked towards this low here. Let me draw a line on that. So we had a small little shallow sweep below this low here. Anything lower than that, we have a small little fair value gap. You can find that on your February 1st, 2023, 2 o'clock or 14:00 1 hour chart candle. Let's drop back down to 15. One of the things that I was looking at this morning that gave me some confidence to work with that short position. If you look at the highs in here, after we traded up into a fair value gap, don't worry, I'm watching real time, but I've already warned you that we're not likely to see something so clean. So while we're waiting for that, I'm going to go over what I did this morning. I shared on Twitter. I uploaded the video too from my phone. And in case you missed it, I wasn't hiding my entry. I actually recorded it and put that portion on Twitter. When I was recording it, my boxers, I have two dogs, and they're a little bit rambunctious when my wife first gets out of bed. And they ran out into the house. She had the bedroom door open, so they ran out there and set off the alarm before I had a chance to deactivate it. So I had to scroll through my phone to go to the deactivation thing for my security system, and then go back to recording again. So that's why it's truncated between a small little piece that's on Twitter and the video that you saw. It was recorded. I just couldn't show you all the pictures and such I have as wallpapers and things as I toggle through my phone. But anyway, we had higher highs in here on E-mini S&P and with the NASDAQ. If you look at the settings down here, I have it set to high. So it's plotting the cumulative line. Remember, we're looking for a buy side run. Remember, we're pushed down. It's not high probability. It's just we're looking for it to dig into overnight trading. Watch this one here. And then this right here, where I was shorting at. Anyone that's held on to their short, they might want to run against that because there's a small little sibby up in here, right up in here. One of the easiest ways to find my cursor, this is something I just thought of while doing this. If you want to know where my cursor is, because I can't highlight it, look on the price axis on the right-hand side of the chart over here. And wherever you see the numbers going up and down, just go to the left and you'll find my cursor that way. Okay. But there's a small little sibby, sell sign of bounce, buy sign of efficiency, and order block right there. So if it gets a little overzealous on the upside and wants to really dig in against the shorts that's been holding overnight, they have buy side here. I'll note it for you. You have buy side here. There. And a really nice one at the point at which I shorted this morning. I shared that with you on Twitter. Why didn't you call it live? I was just waking up, man. Trying to get my bearings. Got to be out here in front of the whole world so you can look at me through a microscope. What makes this guy tick? All right, so anyway, we have higher highs here, lower high on NASDAQ after trading into what? A premium relative to the high to that low, cleared buy side, and that right there was the nice run into it. It was a small little fair value gap also I worked with Pyramid. Again, you can obviously look at the video that I posted on the YouTube channel. So I'm going to take this this way. Minimize that. Make these a little bit thicker so you can see it. All right, so we're going to study and see if we want to drop back lower. I'd like to see this down close candle here at 9:31. These are all 1 minute candles. I'd like to see price maintain above that. You see we came down to it in here, tried to work with it, showed a willingness to want to trade up. But because this market can be choppy, we can go into what? Seek and destroy. Seek and destroy many times starts off like it's a good price run about to unfold. And then you will either engage it or wait for another array to get involved with that price move. For instance, like I'm building the case that we're going to run for these buy side liquidity pools. Okay, that's where my focus is. I'm not going long. I don't want to sell short, but because of the conditions that are in right now, because we come off of a holiday, we had an abbreviated session on Monday, that affects a lot of trading, a lot of sentiment. There isn't a lot of interest right now because everybody's sitting with their hands underneath their hinder parts. They're sitting on their hands waiting to see what the market's going to show. They're waiting for the tip of the hand. Okay, so imagine we're all sitting at the poker table and we're waiting for the market, who has the highest stack of chips. We want to see hopefully that hand that market's holding is getting flashed to us so we can play with a little bit more insight. Right now, it's too soon, too early. My attention is on this down close candle. I want to see price support it, or I want to see price respect it, rather. Let me say it that way. But I'm looking at the likelihood of the market wanting to draw up to this buy side liquidity. If it trades to this buy side liquidity, I want to see it advance quickly through it and work towards this one. It may not do so, but as a real-time tape reading study, that's what we're looking at. In between all the price points that I'm referencing, you want to annotate how much of a price move transpires between the point at which when we draw attention to it and if it goes to a level that we were expecting it to draw to. How many handles? How much time does it take? How much drawdown against that? All those things you want to be logging while you're tape reading. You're not just simply listening to me, hoping I get it right or hoping I get it wrong. You're listening to it and then you're observing and measuring all the fluctuations each time. Over time, you're going to see there's going to be a lot of things that work out in favor, and there's going to be times where it doesn't work out in favor. The main takeaway is right now we've already identified this morning as being difficult. It's going to be difficult. Where everybody else, retail Rick's he's probably only got 6 trades in already today. Every short-term high and low has potential to be swiped. Okay, above and below, above and below. That's really what I want to have your focus on there. But I'm primarily interested in seeing if we can drive up into these buy-side liquidity pools. That would also give me a little bit of a help for potentially what I'm going to likely do if we get a sloppy morning, what I'll look for in the afternoon. Dow futures on its 5-minute chart really had a nice reaction off of a 5-minute fair value gap. You can see that on your Dow, which is YMH2023. The candle on a 5-minute chart is the 7 o'clock candle this morning. Presently on ES, I may refer to charts that I'm not showing you. I'm not going to keep toggling back and forth because number one, I'm going to probably get disoriented and do it incorrectly. So we're going to try to keep our focus here on ES, but I'm just giving you additional insights so you can look at it on your end. So I'm watching the Dow only because it's like a barometer, like the dollar is for me when I'm trading Forex. So far, we've had that down close candle supporting initially. It doesn't mean it's going to stay like this, but it's already shown a willingness to support price in here. And NASDAQ's reaching for its buy-side liquidity pool, essentially around that 12,275 level. So ES should have a nice run into that 40.55 level, 40.55 and a half. The Dow futures are still a little bit heavy, but it's touching a potential bullish breaker on the 5-minute chart. So that's what I'm looking at. You can see that bullish breaker on the 5-minute 9:15 candle. So time candle at the bottom of your chart, you'd be looking for on the Dow chart 09:15. That candle's wick is what I'm looking at. So far on the upside, leadership is being shown with the NASDAQ. Just about there on NASDAQ's buy-side liquidity pool. It just pierced it just now. So we want to see ES try to run to catch up with it. Not seeing any kind of confirmation with risk on, risk off across the Forex pairs, euro and cable, and dollar still stuck in the mud, which, you know, that makes trading for the crosses in Forex better, like euro, pound, Aussie yen, those types of things. Anything that's not a dollar cross, they'll be moving around in a condition like this. ES should be piercing through that buy side next here. NASDAQ still holding above its buy side liquidity pool. And Dow still stuck inside of its middle of its range between its low and the intraday high it's formed since 9:30's opening. If Dow futures can move above its 33,635 low, that should give some lift to ES. There's your buy side liquidity pool. So now you want to screenshot that right there. So we outlined this down close candle. Let me make it a little bit wider so you can see it. We outlined the 931 candle. Okay, so that down close candle, I wanted to see price be supporting this move down into it. It shouldn't pierce through it. It doesn't. The candles also on the next one here goes right down to essentially mean threshold, which is the middle of this down close candle, which is an order block, obviously. So it comes down and then reprices higher. The next candle opens, trades down into a volume imbalance and order block. So it touches it here. And what I was taking your attention to at the time was I was watching the NASDAQ in my other charts. So that way you can have them on an additional window. Like if you're looking, even with a single laptop, you can open up another window that you just hold down hold down Alt and tap the tab button, and you can toggle through your windows. So you can, when you hear me refer to, look at the Dow at this time frame on this particular candle, or look at the NASDAQ. That way you'll be able to see the same thing. You won't have to have 10 monitors in front of you. You can just do it with one laptop. But you want to be referring to other markets to support you, not just simply looking at one time frame of one asset. You might be specializing in trading the ES, because I'm not trying to push you all to do it, but I'm only going to limit my focus to this because it'd be very easy for me to get diluted, and I won't be as effective if I'm looking at all the different things. And if I'm not doing requests like, hey, let's talk about this one. No, we're not doing that. It's not Have Your Way mentorship. We're doing one thing, and everything I'm teaching you in this works in the US 500, works in the US 100, works in the German 30, it works in bond futures, it works in, obviously, the ES futures, it works in Forex, okay? The impatience that you're feeling because you want to trade what you're able to trade and copy whatever I'm talking about, that's not going to happen. You're not going to learn that way. But we've talked about that order block, and the draw on liquidity was here. Now look at what we've got since then. What was above here? Buy stops. What's below here? What's down below this low here? Sell stops. So if we're cautious, because it's a holiday, because it's not likely to be clean price action, the market can do what? It can create that what seek and destroy profile, which is every short-term high and every short-term low will get pierced and swept back and forth, back and forth. And essentially, it can go nowhere all morning session going into lunch. But because we have such a large opening gap lower, we're opening with a discount. The discount is determined because of the opening price being lower than we closed the previous session. So when we have that, the market is going to do what? It's going to favor probing to the upside. Even if this is to go lower, it wants to go higher. Why? Why would it want to go higher? Number one, to move against those people that are short, or to move against those shorts to accumulate their buy stops, then ride that lower. So either way, it's more incentive for it to go towards the buy side liquidity pools, which is why I've referenced them this morning before we even opened up. But it's problematic, even though we've looked at something that delivered 5 handles or more between the order block that I outlined and the buy side it should have drawn to here. That move from here to here, that is your bread and butter setup. That's what I was crowing about in my very foul language Twitter space this weekend, which I thought about after I closed out. I must have said the F word probably 120 times. I apologize, but I was very animated this weekend. And when it's live, it's unfiltered. So we've seen the buy side liquidity on NASDAQ swept above that 12,275 level. So far, we're back below it. Dow is just really unable to do anything. It's already making lower lows. NASDAQ is still way off of its intraday lows from 930. And S&P is in the middle of its range between its low and its intraday high formed here. So we have lower lows being formed on Dow. NASDAQ's near its high of the day from 930's opening, and S&P's in the middle. Does that sound like market symmetry? No, absolutely not. They should be in tandem, moving together. Plain and simple, clean price runs, moving lockstep. Higher, higher, lower, lower. It isn't seen. You aren't seeing that, are you? Exactly what we were expecting. So that is worth its weight in gold. Dollar index is looking to challenge its intraday high. Let me get that high for you so you can find it on your chart. On a 15-minute time frame for dollar, which is the DXY symbol on TradingView, that candle's high at the 415 for today. The high comes in at 104.26. Right now we're trading at 104.17.4. Watch the sell side down here on ES. Even though that NASDAQ is way up there, high up in its intraday high range, it will likely smash down and catch up and take the sell side out on it as well. S&P's just cleaned out its stops below the low here, and Dow is really, really showing weakness. NASDAQ still not making that lower low. So when we have situations like this, you turn your attention to the NASDAQ. If you want to study like a potential setup, you can look for the NASDAQ to try to catch up because it's the stronger one right now. That might change gears and it becomes weakened or sickened because of all of the weight that's placed on the marketplace, like we've seen in the Dow. If you look at the Dow, which is YMH2023 on TradingView, and NASDAQ symbol is NQH2023. Actually, I can do this. Hang on. That's NASDAQ right now. So see the difference between that? I would expect it to run down here. So the setup, if you're paper trading, if you're tape reading, you're going to watch and observe how this market wants to respect maybe this wick consequent encroachment and this consequent encroachment of that wick. Watch between those two. Okay, and see if we can get a run down into the sell side to catch up with what we've already seen in the Dow and in the ES. Do not trade it. Some of you already run into NQ putting orders in. Stop. Okay, this is not the kind of morning for that. Let's go back to ES real quick. Actually, let's leave it on here because I want you to see it run. Let me show you the Dow. There's Dow. See how it's made a lower low? There's your model 22 short sell side. We're trading into it here. ES, let's go back to that real quick. Okay. Ran right to the buy side we were looking for. And let's go to NASDAQ because that's the one that should be delivering on a deferred basis. So you're going to look down here. That's where the liquidity is. All the retail that chased all this run, the books tell them to put their stop loss right below that low. What kind of stop loss is that? A sell stop. Why would they want to take it down there? Because they sold short to all the buy stops resting above this high here. So smart money's short from up here, and they're going to do offset distribution, which is when they short above an old high and accumulate buy stops. The way they want to profit is they wait for the algorithm to reprice below. I said the word I wasn't supposed to be saying, right? They wait for the market to want to go below the old support level, right? Where there's going to be sell stops. So they can short to buy stops and buy sell stops. So that's that market efficiency paradigm that I teach in my core content lessons. Dow is just getting smashed. $40.29.50 on your ES chart. Make sure you have that on there. That is a low from January 30th at 3:30. So January 30th, 2023. Have that level, and again the level is 4029.50. NASDAQ has a small little fair value gap right in here. But we're wild this morning, so you have to consider these wicks. And because there's two of them back to back, I like to look at the midpoint of that one and the midpoint of that one because it can return like it's doing right here. NASDAQ is a little bit of a wild beast. Okay, it exaggerates its moves. And if you're wrong and you're offside, you can get smashed really quick. ES is a little bit more tamer. A lot more professionals trading that one. Not that you can't trade NQ, obviously. So we have NASDAQ with a higher low. See that? Look right here. This low, at the same time, the Dow lower low on Dow, and ES lower low. Okay, so we had a failure to go lower on NASDAQ. We have lower low on the Dow intraday. We have a lower low on ES intraday, and we have yet to see the dollar index. Let me put that up for you too. Don't worry, I'll get better at this as I go. Okay, I just want to make sure I'm not going to lose my space here. So I'm afraid sometimes I might not be doing the right thing with the OBS screen sharing that goes to my YouTube channel. And I'll be talking about a chart that you can't see, but I'm looking at. So we can see that the dollar index has yet to make another higher high. So while you're watching price action this morning, should the dollar index make that higher high, and if we don't see an abrupt reversal on the NASDAQ, because that's the one to watch right now, okay? Because we have a SMT divergence, and that means between the Dow, the S&P, and the NASDAQ, all of them should have made lower lows. They have yet to do that. The NASDAQ has failed to make that lower low. So it could be indicating that this is the morning session intermediate term low, and then we're going to dig higher for buy side and work towards that overnight range that you need to kind of like eat into that range that we've gapped down from yesterday's close to where we opened this morning at 9:30 across all the averages. But if this dollar index were to make a higher high and NASDAQ doesn't make another sustained price run above the 12,275 level, then the Dow S&P pressure of making lower lows, and I said pressure, it's not the selling pressure, but it's the fact that it made a lower low. NASDAQ would want to see, if this dollar makes a higher high, it would want to likely see a lower low on NASDAQ post. And that's how we use intermarket relationships to ferret out moves. Weighing constantly, not just one asset, not one instrument, because you can't simply just use the analysis of one instrument and feel like you're completely informed. You might believe that, you might think that's the case, but you're really, you're running around with one eye closed, and that's just not advantageous. Dow's near its low of the day. I'd like to see this little gap right here stay open. And if we break lower, that would be a breakaway gap. And we could, it looks like it's going to come back for it now. You see? It's back into it. Now, let's just say, for sake of discussion, say we were not on the heels of the holiday. Okay? Say we were not on the heels of holiday, and we had the situation we have right here, where the Dow made lower lows, the S&P made lower lows. As soon as we traded up into that fair value gap right there, I would not, that you should now, understand what I'm saying, I would have used this as a short to get in to make a run for this down here. But I'm not trading NASDAQ, and I'm not inspiring, or hopefully not inspiring, any of you to push a button. But because we're in this market environment, it's still inside the opening range. We have 2 more minutes. It's the first 30 minutes of trading. Once that first 30 minutes is transpired, you want to identify your 15-5 and 1 minute buy side and sell side liquidity pools, and where all of your inefficiencies are. And that's the template that you work with between 10 o'clock and lunchtime noon. Everything will transpire based on that information. Every single day, it's the same thing. But you have to have that first 30 minutes to give you that lay of the land, the territory in which you're going to explore and seek new setups. And it's going to be in the basis of repricing to a premium, repricing to a discount, running stops, or returning to inefficiencies. And there's your drop off that fair value gap we mentioned right there. So you want to screenshot that. That's the setup too, in case those of you want to do the NQ instead of ES. You had another live example here. So let's go back to ES now. See how boring this stuff is? Even on days where it's low probability, it's the same stuff repeating all the time. It's not random. There's no reason for us to be, what just happened? Where'd that come from? That's infancy. That's somebody that doesn't know what they're doing, or highly emotional. I get emotional in Twitter spaces, but not in price action. So now we have the condition where we have all 3 averages, the Dow, the NASDAQ, and the ES. All of them now have made lower lows. All of them. So now we refer to what? What's our final qualification for bias? The dollar index. Has the dollar index made that higher high? Not yet. So because we have done that in the ES, making lower lows, S&P lower lows, and NASDAQ lower lows, we would expect to see dollar pierce through that 104.26 to the upside. By doing that, we would also further expect like the euro to go lower and cable to go lower. Cable has a very large buy side, buy side and balance, sell side inefficiency on pound dollar, and I use the forex.com pair on TradingView. If you look at the 430 candle on your 15-minute time frame, that's a big buy side and balance, sell side inefficiency. If you pull up your fib on that, measure that consequent encroachment, which would be measured from the high of the candle, and I'm talking about pound dollar right now for those that are in forex, at the 415 candle of today, that high up to the low of the 445 candle on a 15-minute time frame for pound dollar. That big green candle, that's your buy side and balance, sell side efficiency. The consequent encroachment comes in at 1.20434. So if we can get the dollar index to run up through that 104.26, I would look for pound dollar to try to gravitate towards that 120.43 level. Doesn't mean it's going to go to it, but it's all dependent on that dollar doing that. So I'm trying to toss you a bone that those that want to be trading Forex, you're not really interested in all this other stuff, and it's hard for me to hold your attention because it's a pair or a market that you're not trading. Understand it's all part of it. Okay, it's all part of the things that we look at as a holistic approach to analysis, not just simply I'm a day trader, I'm working with the euro dollar, I'm not going to look at anything else, not dollar, not pound, not anything else. That's myopic, too myopic of an approach with analysis. You have to incorporate other things, so intermarket and intra-market analysis, things that are related, inversely correlated, or positively correlated. Dollar to Forex pairs is inversely correlated. Dollar is inversely correlated to equities and stocks. If the dollar is going higher, that's risk off. It's going to be easy to see shorts form in index futures and Forex pairs. So because we've already we've already met the lower low condition across all three averages, Dow, S&P, and NASDAQ, and we have not seen the dollar index make that higher high, we now have what? A dollar SMT divergence. So we did not confirm a higher high with the dollar index, meaning that these lows here on ES, NASDAQ, and Dow could potentially be forming what? An intermediate term low. Go back to ES. 40.2950. Yeah, 40.2950. Make sure you have that on your chart for ES. Okay, that's where it is here. That's the next sell side liquidity pool that I'm interested in. NASDAQ is just banging around in its lower quadrant of its intraday range today, meandering around between 12.232 and 12.215. You don't see me doing it, but I'm kind of audibly walking you through it. I have all these monitors in front of me, and what I'm constantly toggling my attention through, I look through I have an intraday matrix where I have a 1 minute, 2 minute, 3 minute, and 4 minute chart on the NASDAQ, and then I have the same thing for the E-mini S&P. So I'm looking through that constantly, looking for small little micro gaps and inefficiencies there. And I'm looking at the relationship between all the other markets. I'm looking at the NASDAQ, where it's trading in respect to what the S&P is doing, and also with the Dow, which Dow is the leader to the downside. It's the weakest one today. And I'm watching the dollar index. So I'm constantly moving my attention through all of the charts and screens in front of me. So that way I'm constantly taking in information. I'm getting a read on everything. I'm not just looking at one tree with my nose against the bark of the tree and thinking I'm seeing the forest. I'm not. This way, I'm looking with a panoramic view over the entirety of the marketplace as best as you can accumulate through these instruments collectively. Now, obviously, you can look at a whole bunch of things. NASDAQ just ripped to a new lower low. S&P has let me go back here. 1 minute chart. S&P should sell off in here now. You have lower low on NASDAQ. Dow's made lower lows, but it's off its low now. So we would want to see the S&P take out that low here. The benefit of something like this that you're sitting and being a part of is you're learning how to tape read. We've talked about moves before it happened. We talked about what it should do, what it should be more sensitive to, even in NASDAQ, and it's delivered. I mentioned two things in NASDAQ that were very influential, and you should be going back and listening to this recording and ferreting that out and putting it in your charts and annotating as well. But you can't confidently, because if you read the comments in my videos, that the one that still allow comments, I don't want to be babysitting. There's so many people that spam and try to get people thinking that I'm running services somewhere else. Join this room. ICT is going to teach you the mentorship when mentorship is here, right here live. Um, I don't want to babysit comments, but in those comment sections, you'll see many times folks will say, how do you trust? How do you know? See the dollar index while I'm talking. You want to look at the dollar, how it's really failed to make that higher high. And now because the S&P was unable to make that lower low, in concert with the lower lows in NASDAQ, this is that potential intermediate term low that may be forming here for the morning session. And the dollar index really fell off, trading at 104.04. But you'll never understand what it means for me to say it's experience, which sounds like to a new student, to a new viewer, or a new subscriber to my YouTube channel or to these live sessions or looking at my tweets. It sounds like a cop-out, like, okay, well, he doesn't really want to teach me because he's saying it's just experience. The experience is gathered by watching me do this. This is what I did for a long, long time. When I first started, that initial luck, which is what it was, it wore off. And I didn't know how to trade. I had to teach myself to look for certain things and trust it. And just like you, if you're new, you're having a difficult time trusting things that I'm teaching. It feels confident. You feel confident when you look at it. I want to see it make that lower low still on S&P. Even though the dollar index is off its highs, I still want to see it pierce that low on S&P. Now, because I'm looking at the lows, I'm toggling the setting to price source to low. So that way, if it makes a lower low here, and say the NASDAQ doesn't do it, that'll be SMT divergence. And then if it does that, I'll comment at that time. Right now, we're just watching it. But you can't appreciate the necessity for experience and how it teaches the influence of having been here so many times before and not being emotionally charged about the outcome. I'm sitting out in front of all of you. I could be wrong. I told you that we were going to see a challenging morning. It's pretty challenging. This isn't a clean price run day, even though we had a lot of movement. When we went to our buy side, I said, okay, now because it could be seek and destroy and the other factors I've outlined here, it could, and it started delivering towards the low end. I said, now watch the sell side. The cynics that come and just simply want to know black or white, binary, on or off, buy or sell, give me a trade to track you. They're not going to see the benefit in this because it's not something that they can go out and make money with, or they can fault someone for losing if it was wrong. So it's a very frustrating thing for a troll to watch this because they want something to run with. Whereas a student can come here and see this and watch and observe a very objective approach to reading price action. There's nothing charged emotionally here. I have no benefit or consequence if I'm wrong, which is exactly the benefit that you will experience by learning how to read price action on your own, where there is no outcome that is going to either favored because it was profitable or feared because it's going to be a monetary loss. That stage of learning how to trade is the absolute sweet spot for learning, but no educator emphasizes that. No educator, not one of them does that. You have to have that. And it can't be rushed. You can't just say, I've done 20 sample sets of this pattern. I back tested for 3 months or 6 months, and you can't walk away thinking you're now prepared because you're not. The only thing you're prepared to do is gamble. And I'm trying to do my best to inspire you to do this stage and not rush through it. Should be piercing that low here. Here we go. NASDAQ just fell out of bed. Dow just tanked even more. Dollar still, unfortunately, is still in its range. So we'll be looking for, even though the dollar might not go that higher high, it could change gears later on. But right now, I'm monitoring that 40.29.50 level still on ES. that's in play for me until we take out 40.49, whatever this high is here. What's this high? Yeah, 40.49 changes the whole lay of the land for me. We'll see 40.29.50 as long as we're below 40.48 3/4. And again, I told you earlier in the stream where that is. It's in January, that old low. So, I mean, you'll get more comfortable as you watch price action, even on the times that I'm not doing it, because obviously I'm only doing the live sessions in specific times. But the idea of watching it, taking in the information you're seeing, weighing the effects and the confirmations that you would expect to see in other markets, Dow, NASDAQ, all those things lend well to support, and you'll trust those things to build your confidence. The part that you have right now that is fearful is because you haven't done this enough. This right here, looking at it, trusting that it's going to do certain things. And because you have these laboratory experiments where you're safe, you can't lose money from watching price action. You're not even pushing a demo account. I'm not pushing a button. You're not pushing a button. But you're taking in all this information that a book and a trading course does not fulfill. My mentorship doesn't fulfill. This is why I said when people were taking my content and sharing it on Telegram and sharing it on Discord channels and sharing it everywhere and selling it and repackaging it and renaming it and all those things, the individuals, yes, they'll have a little splash over effect because sometimes the things that they'll learn, it's pretty much going to deliver like that. But these instruments have conditions that make it sometimes hard. And unless you sit down with me, like my private mentorship experience, and now you're having that experience, so stop asking to join the mentorship. I am doing mentorship. This is exactly what I was doing with them, but better. I'm not distracted by all the people that were trying to talk to me in my mentorship at the time, asking me questions that had nothing to do with what I was referring to, which is why I'm adamant about having my approach to teaching you and stop letting other people influence me to tell me how I should teach. I know what works. You're coming to me with a small stage of confusion, a lack of understanding, but you think that you know how you should be taught. You don't. I know how you should be taught. And every time I deviated from what I know works, it made it harder for me as the educator and harder for the students. So if you don't like this approach to learning, obviously there's plenty other YouTubers out there. There's plenty other educators and people that will, I'm sure, help you. You'll spend money and you'll probably lose money, but here you're protected. You're not going to lose money. I promise you the things I'm talking about work and you're seeing it. I'm out here live right here and I'm explaining what it should and shouldn't do. There's no books out there. I got 2,000 plus books. Not one of those books ever taught what I'm teaching you. It doesn't exist. These educators, if they know what they're doing, they'll come out here and they'll explain their methodology in front of you live. And if it works, you'll see it. If it fails and it can still make positive returns in terms of the signal formation, the delivery of price, losing is not a problem. But if they can't prove the efficiency behind the idea, or if they even can do it at all, not just use hindsight or market replay, then you probably don't have the best educator. And I'm not claiming to be the best educator. I'm just promising you I have the best way of interpreting price action. And I'm learning, hopefully, over time to be a better mentor. We're looking for that 40.29.50 I mentioned a little while ago. See if we can pierce down through that. And should it do that, I will consider this morning a wrap. You can't rush to making money, okay? I know it feels like, the end of the world's just around the corner and everybody wants to go out and buy their Lamborghini before it does. But you gotta be practical, folks, and that's all I'm trying to be. I'm trying to be practical. There's lots of ways to skin a cat, yes. There's lots of ways to find profitability, yes. But you cannot speed up proper learning. And if you're here to learn how to read price action and interpret intraday price fluctuations to be a day trader or a short-term trader that can be used to be position entries on larger scale trades like long-term position trading or swing trading, all of these things that I'm teaching you have a place in that, which is, again, why I like to teach in these lower time frames, because it's dynamic. Number one, you get instant feedback. If you're wrong, you'll know. If you're right, you'll know. And you'll have another new example forming, just in a short little while. Inside of a 1 hour time period, inside of 60 minutes, you can see as many as 2 or 3 setups. But you don't identify them because you don't have the experience yet. But you'll get it. And once you get it, no one can take it back. I can't call it back from you. No one can steal it from you, and they won't ever be able to diminish it because they troll you or what you're learning here or me. It has no benefit. Once you know it, you know it, and it can't be taken away. And you don't ever have to worry about it, never, or fearing that it's going to stop working. I can't tell you how many times over the 20-some plus years of me teaching it, it isn't going to stop working, folks. Okay, there's going to be days that you lose, and there's going to be days that I lose. It just means that was a day that you did something wrong. You did something wrong. The methodology is not broken. The logic is not failed and flawed. It just means you as the operator, me as the trader, I did something wrong, and you have to be very responsible about what it is that you're doing. And if you lose, you own it. You embrace it. You don't run from it. You don't try to fault me. You don't fault the concepts. You don't fault the broker. You put your stop in the wrong place if you get stopped out, or you're on the wrong side of the marketplace. That's the only two things that you need to identify learning with me. And that's responsibility. And some of you and some of the folks that have gone through my fold don't want to be responsible. They want to be able to claim the credit when it's working, but they want to defer the pain and say it was somebody else outside of them or something outside of them externally that caused that to happen to them because they feel like they're infallible. That is an infancy mindset. That's a neophyte. That's someone that is putting blinders on. They're never trying to really learn how to be a good trader if they're thinking that way. You're looking for the sugar, but you're going to have to taste the vinegar too. And a lot of people can't do it. They want binary, black and white, on or off, profit only, never lose, never draw down, never stopped out. And that's, unfortunately, I don't promise that here. You're going to lose, and you're going to learn when you lose. And there's nothing to be fearful of because this stuff will repeat, and you'll find a favorable setup. You'll find those things that repeat over and over and over again, and you're going to see things new this year. Like I mentioned, with the new week opening gap. A lot of people are like, oh, that's the talk of the town now. That's the new flavor. And anytime I introduce something new, it's like you want to stop looking at the things that you already know and just chase this new toy. And there's other setups that's forming with the things that you've already been taught, but you're not seeing them now because you're all looking at the new toy. That toy, that new week opening gap, that's just a small cog in the great machine that is my algorithm. It's one little piece that when it's there, it's useful. But we're away from that new week opening gap. Remember that? The new week opening gap for this week is way above us. When I was teaching you, when I first introduced it 2 weeks ago, I said that new week opening gap is a magnet for price action, and it will use that reference point in price for constant referral to fair value. It's a fair value range that continuously will be referred back to as long as we're in consolidation. But in instances where we move away from that new week opening gap, and again, for those that are new, you're wondering what that is, the new week opening gap is the closing price on Friday, and then the opening price on Sunday. When the markets open up, whether it be Forex, whether it be stock index futures, whatever, it works on stocks too individually. So I have a lot of folks that are interested in stocks. They like trading the SPY. They like trading the triple Qs. Okay, it works there too. These signatures are algorithmic. It has nothing to do with anything retail. They're very specific ranges, and they're very specific levels. The highest high of the gap, the lowest low of the gap. the midpoint, which is consequent encroachment. Consequent encroachment is always the mid-range or middle point of an imbalance or inefficiency gap. A wick, algorithms see wicks on candles, that is a gap to it. So it's going to split it in half, and that's consequent encroachment. I've taught you that as well in the last 2 weeks. These factors will help you trust the market profile that you're in. Now, let's go back and refer to how I opened this live session up this morning. I stated that we were on the heels of a holiday that was yesterday. So we had abbreviated trading session hours yesterday, 9:30 to noon, and then trading stopped. I don't like trading on holidays because you're already demanding a lot of delivery and price inside of a small little range of time. It could do it, but I got better things to do instead of sitting in front of a chart and try to demand a move inside of 2.5 hours. Could I? Yes. Should you? No. Can you go back and study it? Yeah. Is it beneficial? Sure it is. But because we're opening up on the heels of a holiday, we had truncated trading hours, not the full trading session hours. It's like coming off of the Christmas break. You got to let the market fall back in to its normalcy, because there isn't a rush for people. Only retail traders, the small-handed street money traders, are rushing to get back in here the very first minute that the market opens up after a holiday. They can't stand it. It's like they've been kept from the casino too long, and they can't wait to go in there and pull the one-armed bandit little slot machines, because they have to have an experience. You don't want to have experiences in trading. You want to be speculating with the probability in your favor. So if we didn't have the holiday factor that we mentioned this morning, and you should have in your notes, anytime we have a holiday, that's going to be impactful to trading on the very next morning session. It's going to make it difficult. It's going to be fickle. Okay, the market's going to be more prone to do what? Create seek and destroy conditions. We didn't get it this morning, but it very well could have happened. It very well could have happened. And that would have been wonderful for you to be able to see, oh, it happened. No problem. We adapted. We watched it run to the buy side. And I mentioned, because it could be what? Seek and destroy. We have to be mindful, where's the sell stops? It went down to it. And then NASDAQ was the outperformer on the upside. We watched it at its buy side liquidity. It gave up the ghost and went down below it. It started to catch up with the Dow and the ES. And then I took your attention into the NASDAQ, and I told you between those two consequent encroachments on those two wicks, which I'll take back to in a moment. I'm observing the relative equal lows that they're placing here on ES. If we didn't have the holiday setting that we opened up trading into this morning, because we're so far away from the new week opening gap, and we failed to run higher after taking that buy side here on ES, once we broke down like that and we moved into this fair value gap here, then we're in a trending model. Trending where? Lower. Why? Because we're so far away from the new week opening gap. It's not interested to go back up into the Friday closing price and the opening price on Sunday. It's not interested to revisit that. So there's a factor of weighing out market profiles, conditions, not market profile, like some of you trade with the approach of, it's not the same. And I know I'm not looking at market profile like you might be thinking. I'm saying like templates, okay, a schematic, a roadmap, a way of expecting price to deliver a very generic procedure or process. If it's going to be trending, if it's going to be in a condition of market trending, not just consolidation and choppy range-bound consolidation. Range-bound consolidations are expected and confirmed when price continuously stays real close and returns back to frequently the new week opening gap. If the market can stage a run away from that new week opening gap, and we're not on the heels of holiday setting, expect trending. How do you know when it's going to be a trending model and when it's going to be consolidation? I just taught you. Again, I taught this when I first introduced the week opening gap. If we're going to be in range-bound conditions, it's important to know what tools they refer to. That way it helps you. It keeps you founded on sound logic and not chasing every minor little fluctuation in price action. There's rules. There's processes. There's things that we have to use for filtering. And you thought it was just simply go in here and look for an order block or a fair value gap and you're going to be rich. No. No. There's no 5-minute learn ICT trainer that's going to give you consistency. They might introduce a concept in a very abbreviated fashion for clicks and views on their YouTube channel. But they're not going to dig into what's needed for you to be successful with what I've adopted, created, and authored. You can't shortcut this stuff. There's a right way of doing it. Watch the expansion here on the downside. I'm just looking at other charts. I didn't lose audio. NASDAQ made its lower low, and Dow has yet to do so. Okay, you want to screenshot your ES chart. So 40.2950 is printed. I'd prefer to see it at least make an expansion below that because it just would favor to do that. But it printed the 49.2950 level. Everyone that took my trade idea, they're covering a short now. They're thinking, man, this stuff just keeps working. Yeah, wait till you're into it 30 years and it still works. It's boring. Right now, it feels like Christmas every day. But it's important to talk yourself down. Don't get all hopped up on goofballs. Lots of learning still for us this year. Just want to see it pierce the 40.2950 level a little bit more meaningfully. Then I'll go back through everything we covered this morning and give you the takeaways. That way you can, put it in your journal. What happens if it runs away from the 40.2950 level? Then I would treat that as an afternoon objective because the liquidity that has not been really purged below it. And you're probably thinking, where did I get the 40.2950 level? Where did that even come from? If you pull up your regular trading hours, in other words, the lower right-hand corner on your ES chart, here, toggle that. It'll say regular trading hours. Hit that, and then 15-minute time frame. That's that low right here. Okay, so January 30th, that Monday, at 345 or 15:45, the candle time at the bottom of the chart as I'm showing you here. We want to see it pierce through that. All these things I got to remember. Right. Exactly what I told you. You're going to have to work. It's so easy once you know what you're supposed to be doing, but it's so hard being disciplined and trying to go through the process of finding yourself in all of this. So we pierced it a little bit, but I still would have expected a nice big beefy candle down. So we went from a buy-side liquidity pool I mentioned beforehand here, and walked you through the internals across the market, how they were indicating that we were not seeing follow through. We did not see things that we would like to see across the other markets that would support a sustained price run. I'm watching Dow right now. Dow's off of its lows. Let's see if it can go down and make it a lower low. Nasdaq's made its lower low. S&P's made its lower low. S&P has hit the target that we aimed for today. It's 40.2950. But I'm watching the Dow. If the Dow can make a lower low, that would be a nice expansion on the downside for ES, which would be really what I prefer to see. And I gave you a filter stating that as long as we remain below 40.48 or 40.49 specifically is what I said it back here before I dropped the line. As long as we remain below that, we would see 40.2950. Why? Because there's liquidity drawn, or a draw on liquidity to that low. Why? Because it's a higher time frame reference point, and large funds have their orders resting there. Let me say it this way so that way it doesn't sound so abrasive. When you're looking at price and you're putting your stop loss and it goes to your stop loss, the market doesn't see your stop loss. You're not even trading at a size that it even refers to as important or significant. The market is going to gyrate to these levels continuously to inspire, to instigate, or to purge actual orders coming into the marketplace. In layman's terms, it goes above old highs to engage buy stops. Those buy stops may be resting above that old high for the purpose of protecting a short position or a new entry long. They may be viewing that high being broken to the upside as a means or a catalyst to get them long. The same thing said in reverse below an old low. There's sell stops below that old low. That sell stop may be a mechanism or catalyst that sets the trader that uses it to get short, selling short on a breakout to the downside, selling weakness in other words. Or that sell stop could be a protection mechanism for a long position. We don't care. We don't care. You can look at the chart and see what it's really predominantly, if it's really protecting longs or if it's a new breakout to the downside based on what the price has done. For instance, what kind of buy stop would be resting above this high here? Protecting a short. Why? Because the market's delivered down. So it's not rocket science. It's simple. Above that old high is a buy side liquidity pool, but it's for what purpose? Protecting short positions. Now, I'm not saying or being dogmatic about that's the only way it's utilized there, because there still may be someone out there thinking, okay, I want to be long, and if it takes out today's high, I want to be a buyer. For instance, Larry Williams would trade something like that. I've seen many of his old stuff, and he would have something like that. He would be buying strength. I lost money doing that. He's proven he made money doing it. Every time I tried to buy strength, I did it incorrectly because I mislabeled what I thought was a reference point to be buying strength because I was a new trader. 20-year-old, read 2 books, and I figured I knew everything. I didn't know anything at all, much like some of you, because you watch a few of my videos. Maybe you sat in a few of these live streams now, and you had these little epiphanies, these aha moments, and you feel like it's all clicked together. What you're saying is you're giving yourself permission to go start trading live still before you should. I know what you're doing. It's the same thing everybody does. And you don't want to pay those painful lessons and pick up scar tissue that will prevent you from learning quicker if you don't do it. You want to learn how to do this the fastest way? Do everything I'm telling you to do this year. And do it for the remainder until the second week of November, the second Friday of November. That's our last live stream. And at that moment, you have gone through a ICT mentorship. And all the experience that you have at that moment, now you can start going forward with everything you wanted to do. But until you get to that point, you're not ready. And I don't care what educator, whether competitor, YouTuber, if they're trading live, if they're not trading live, I don't care. They don't know what they're talking about, okay? They have no idea what they're talking about. This is my concept. This is my concept. This is my approach to trading. You cannot learn it on the fast track. You can't. There's so many variables, and each one of those variables open up the opportunity for you to find your own personal approach to using it, which is how it's done correctly, instead of me saying, here's model 2022. In my opinion, I felt that that was the most universal approach to trading with my concept, with my approach. But some still can't find their way in it. Okay. You'll find your way if you stay with us each day. Show up every day. You're going to miss your favorite channel shows. Okay. DVR them. You'll watch them when you get done in November. Spend the rest of the holiday season catching up with your old stuff. But you have to put your face in front of these charts and listen to me as I'm explaining every single individual candle. I'm walking you through the logic, why the market should be doing this and why it shouldn't do that. Where should it be going to? That's the thing that you need. It's not the entry. It's not the order block. It's not the fair value gap that doesn't fill. That you're sweating all that stuff when it's the least important thing. I promise you, every YouTuber out there had no idea that 40-29-50 was where we're going today. And that's not a knock against any of them. And I like a lot of them. They don't know. That's all. It's just they don't know. But they're learning. If they watch this stuff, they're learning just like you are. And that's what I'm here for. I'm not here to compete against anybody. I'm not trying to belittle anybody. But if you want to know how these markets book, you're at the right place. You're hearing the person that's going to tell you how to do it. I'm going to walk it with you every day. And by watching real-time price action like this, you're going to see your setup. Your eye's going to jump to it. It's going to make perfect sense. Even if I don't like that particular PD array or that specific element, I may not even talk about that one at that time. But you see it and you trust it because you hear me saying what? It's going to go down to 40-29-50. It should stay bearish, and as long as it stays below 40-49. Well, then you start looking at consequent encroachment of fair value gaps. You're looking for bearish order blocks. You're looking for optimal trade entries, institutional order flow entry drills, everything or anything that you're trusting. But because you're listening to me in the 3 decades of experience of me sharing that with you, you know I'm not out here just throwing a dice and hoping when I fling mud against the wall something sticks. I'm telling you where to go, where it's going to gravitate towards, and what it shouldn't do. The new viewer looks at this and thinks, well, what's the benefit of all this? You're too new. You can't appreciate it. But the folks that have gone through my content and they know what a breaker is, they know what a fair value gap is, they know what an institutional order flow entry drill is, they know a fair value gap consequent encroachment, they know the wick consequent encroachment, they know all these things. They just don't know when to use them because they don't know how to determine bias. They don't know how to determine the direction. If they could just know where the market's going to go next, then they could easily go in there and pick the thing that they'd like to trade. But because they don't want to do what I'm forcing you all to do with me live, which is observe price action with no monetary reward or risk of loss, they don't want to submit to that. Because their fear is, if they waste their time doing all this and they still can't do it, what a waste. When I say the fact that you don't want to do this, what a waste. You're cheating yourself of the real learning experience that's being made available to you for free. For free. All you have to do is show up every day. And you'll learn bias. You'll learn market profiles, the real market profile. How to determine the market schematics real time before it starts to deliver. And you don't have to be emotional about it. You don't have to be scared. I'm more animated now because I'm trying to convince you to just keep showing up. You'll see more evidence. You'll see proof. Nothing's contrived here. Nothing's conjecture. It's science, okay? It's all coded. But you have to wait for these things to start unraveling before you can determine with a great deal of probability that it's going to do specific things. And that impatience factor that you're feeling right now, it's insatiable because you're in a hurry to make money. And that's understandable. That's understandable. But you have to squash that. You have to really work hard to not do that because there is no limit to what you can earn. There is a limit on how much you can lose. Everything you got. And you're in a hurry to push that, try to over leverage that, whatever that amount is, whatever the amount of the funded account you're going to try to acquire, whatever the amount of money you're going to open up your account with, and trade prematurely through ignorance. And it will be debilitating emotionally and psychologically if you do that. You won't want to come back to these live sessions because you're going to be toxic. You're going to be thinking about everything I say, and you're going to be critical about it because you want to find something so you can feel justified that it was me, not you, that caused you to lose your money when it was me all this time telling you don't trade with real money, and you're going to learn how to trade. You'll be able to read these candlesticks before they print, but you can't do it when you're worrying about the outcome of your trade, following what I'm talking about in these live streams, if they're going to be profitable or not. And if you made money this morning based on what I said, you did not learn anything. You have done the worst disservice to yourself by doing that. Because you are taking this experience and weighing it in the term of, I made money, this is how much drawdown I had, I feel good, I feel confident. And you think that that's the empowerment that you need, when I'm telling you it's not. That is not the way to do this. You have to be indifferent, completely detached from the outcome being monetarily rewarding or painfully by way of a loss. That's the only way you can ferret out the thing that you're looking for, because it won't be inspired by money. The candlesticks are going to repeat. They're going to keep doing the same things I'm telling you they're going to do. Okay, that's going to happen. All year long, it's going to do the same thing. But you're not going to appreciate or get the benefit of knowing the best approach for you as the trader using this content. Because breakers are not going to be for everybody. A fair value gap is not going to be for everybody. I'm a realist. I know that. But I'm trying to be a voice of reason so you can do this the right way and not waste your time. It's not wasting time studying. It's never, never a waste of time. The surgeons that did surgery on you or your loved ones, you think they just watched a video, a 5-minute trainer on brain surgery, and they're going to remove your loved one's brain tumor, and you're going to trust that? They deserve their annual salary because they watched a 5-minute trainer? Come on, man. Come on. At some time, some point, you're going to have to say, you know what? This really does require a little bit more knowledge, patience, and I have to be highly organized. I can't be in here just rolling the dice. And I tweeted the other day, I said, many of you that rush out to try to trade with real money, this is the part where most people drop off the videos. They don't want to listen to this stuff, but that's the reason why they never make it. These are the things you're going to be thinking about, or the equivalent that is pertinent to your personal life. But if you are in a rush to trade your live money accounts or your funded accounts, and you're impulsively in here just trying to push a button because you think you might see something here, you want it to go 5 handles, you want it to go 20 handles, but you know what? Subconsciously, you're thinking, if I could just get $200 out of this trade, I'm just going to collapse it right there. But what happens is you get into it, and it might move in your favor a little bit. And instead of getting out that little stupid trade target you had, which makes no sense for having taken it anyway, it moves just a little bit more, and then you fall in love with it. And then it reverses and takes you out. Or you don't have a stop loss, and you just let it rip against you. And then you feel regret because you then remember that there was no reason for you to push that button to get in that trade, but you needed something to distract you from the painful existence you have right now, living a mundane life. I was like that too. Nobody ever becomes consistently profitable, independently wealthy, and living off their trading by doing that kind of stuff. That never, ever, ever leads to consistency. It never does. The only thing consistent is you lose consistently and you regret. Instead of sitting back, observing, doing these laboratory experiments each day, understanding that the outcome will be that you will know what you're looking for in price. 40, 29, 50. You were told that earlier in the session, and it delivered it. The buy-side liquidity pool, we watched that. I mentioned that we would likely draw up here. Even if it was to go where? Go back and watch the beginning of the stream. Go lower. It's beneficial for it to go up to that buy-side liquidity. Why? Because buy stocks would be accumulated as shorts by smart money. And they would do what? Let it ride. It's not their selling. It's not short sellers pressuring the market to go down to that level that nobody else has been talking about, 40, 29, 50. 40 to 29, 50 is where the algorithm is going to refer back to. And it doesn't matter how many contracts are being sold short or how many are being bought long, it's going to print and book that price. And you watched it happen today. There was no trend lines required, no moving averages, nothing harmonic. It was just simply algorithmic principles and theory in play over real-time price action. I walked through the filtering process using the other market instruments to justify or negate an idea. Things that we were looking for, if they fail, the contrary is what's true. And you ferret out your trading by doing that. The skeptic in the audience, and I have them, they'll come in, they'll listen to this, and they'll go through and they'll cherry pick things where we were watching something, making an observation about something. And they'll say, look at this right here. He said this is going to happen. And it didn't happen. Right, that's information. That gives you a point of measurement. Is this move sustainable? Because if this doesn't fulfill, or if it does fulfill, for instance, the 40, 49 level, I said as long as we're below that, 40, 29, 50 is being booked. Oh, that's obvious. That's obvious. Go back and watch the live stream. I walked everything right here. And over time, when the markets are more cleaner, not on the heels of a holiday, not every day is going to be a holiday, right? So tomorrow when we trade, well, let me rephrase that. Tomorrow when we tape read live, we'll probably have more favorable. That's what I want to see. I want to see a little bit of an expansion here. The fact that we have the Dow off of its lows, let me show you real quick. See how we're off the lows on the Dow? That's Bailey Bark, in case you heard that. And then you have the NASDAQ. Real close to its lows. And an ES made that lower low. So, and Dow, I'm sorry, the dollar index has really slipped, went lower. So let's look at that now also. And I'll show you what that means to me. Okay, and look at the dollar index. We were using the 15-minute as a reference point. So we didn't get that higher high, and it failed. So now think about what this is indicating. If the dollar's not rallying, okay, and it's dropping lower, while euro is going higher, pound is going higher, so we have what? Potentially risk on. Because if dollar's going lower, that means we want to start seeing the low be respected in the indices. We want to look for a shift in market structure that would be bullish while this condition is in play. If we take out the high here, that changes that. So this is how I frame what I'm looking to do in the afternoon. How do you know how to do what it is you're looking for? How do you, what procedures do you have? What routine do you have? What I'm walking you through. I'm looking at the relationships to other markets through the scope and lens of risk on and risk off. since we've had dollar fail to make that higher high, which is where I was taking your attention, it slipped lower. But also notice while it's doing that, what's also occurring? Yes, it was going lower. But it went down to a higher time frame pool of liquidity down here. So if the dollar was to continuously drop and stay soft, go lower, remain heavy, in other words, heavy means it's likely to be more likely to continue going lower. We're watching and observing, and you should be watching that throughout today with the dollar index, and the symbol is DXY. If that occurs, and that's the case, we're constantly monitoring the averages of the ES, the NASDAQ, and the Dow. If at any time intraday there's a shift in market structure that's bullish, that might be a catalyst for this to have a deeper retracement intraday. But if the dollar index remains consolidated inside of its low formed, let me just put the chart up. I hope I'm showing these charts where you can see them. I don't know. So please be forgiving to me because I'm learning as I do this. But if you can see the dollar index chart, this low right here where my cursor is, should be. As long as we are inside that low and the low right here, if we're just bouncing around in here, the NASDAQ and the S&P and Dow could still go lower because this is being held in consolidation. But if we break below these lows here and get really animated to the downside in dollar, it's going to be an interesting afternoon session for trading long for me. That's what I would like to see. But I have to weigh it out and see what we get at the time. And I wouldn't be considering anything until 1:30. That's usually when I sit down and take a look at the charts. Between 1:30 and 2:30, some time in between those two price points and time windows, I usually have a pretty good idea of what I'm looking to engage. Not all the time, but usually by then. So because I spent the entirety of this morning, and I thought this morning was pretty fruitful, on Twitter, I will share a tweet with a liquidity that I think is useful going into the last hour of trading. So that way you can at least paper trade it, demo trade it, tape read it, all the things that you like to do. You can use that information there and get whatever information you get from it. Don't live trade it, please, because I don't like it. And even when you make money, please don't tweet to me because I'm not gonna high five. You're just giving me anxiety. I've asked you not to do that, and I don't want to be talking about what I think the market's going to do, knowing that there's people out there copying me. I know they're doing it, but just don't tell me about it because it just gives me things to worry about. It's kind of like you're my child and I gave you the keys to your first car, and I'm panicking. I don't want to see or hear that. Hey, Dad, come pick me up. I just hit a tree. I don't want to know that. Let's go to NASDAQ real quick. If you're here and you are of the mindset that this is beneficial to you and you're gradually understanding more about price action and how you're learning how to control yourself and the impulsiveness that comes over people when they're sitting in front of the charts, if it's beneficial to you, if you like this, it's a great encouragement to me if you give the video a thumbs up. I don't get anything extra for it. I have not seen any additional increase of any ad revenue for the fact of there's more thumbs up. There's people that say that it has a effect on how much more money you make or whatever. It has made no more money. It has done nothing. But it's a reference point that I look at because if I'm hitting the right places in your understanding, I'll know that because of your liking of the video. That thumbs up tells me. Obviously, I can't see the thumbs down. Nobody really can see that. But I know there's 12 of you out there that are doing it. Even if I made $1 million in front of you live and you could copy me, you'd still thumb down the video. I know there's some of you that appreciate this, but I'm hoping over time throughout the course of this year that thumbs up will become much more prominent because more of you will have gained the understanding that you don't really appreciate yet. But by watching price action every day, reading it, you'll know what it is that you're looking for. that you don't know. You don't know it now. You don't know what you're looking for. You don't know what your setup's going to be. You don't know how to adapt. You might go into the marketplace looking for a particular scenario, and then the price delivers in a way where it completely negates that whole idea. What are you going to do as the trader at that time? Are you going to lose your mind and say, that's it, I can't trade anymore, this stuff doesn't work? Or are you going to say, oh, let me reevaluate and see what's going on? Okay, now I can clearly see what I was expecting initially. That is not in alignment with what the market's doing right now. So I have to adapt. Or sit on your hands and have no regret or impatience by doing it. That's maturity. 90% of you don't have that yet. You don't have that yet. And it's not a knock against you. I didn't have it either. It had to be forged over losing real money. And then learning that, hey, I have to slow down and let myself learn, give myself permission and time to learn. But it's all going to be a different experience for all of you. So now we have a nice move below that 40, 29, 50 level. That's, in my opinion, much more meaningful. The liquidity that would be resting below that on the fund level, as I was mentioning earlier, the market doesn't see your one contract and think, I got to go down there and get that one contract guy. Or I got to go those 2 micro lots. Because there's a guy down there, there's a gal down there, there's a bunch of people in on the Twitter guy space that he thinks this level's interesting. So we got to go down there and get all 35 of those contracts collectively. That's not how it works. The algorithm has absolutely, oops, I said the word that wasn't supposed to be said. The market has no way of knowing how many orders rest above or below. And you think when you watch the depth of market and you're reading the DOM, you think those orders are all real. There's a lot of spoofing that goes on there. You don't know what that is. Nobody knows because the orders are coming in and out all the time. They're being placed and then pulled and placed and then pulled. The algorithm doesn't need to know how many there is. It just refers back to those old reference points and it's going to deliver price up there. And it's up to the traders to use the available liquidity at that moment and at that time, at that price. They, the collective smart money, they may not efficiently engage it. They're out, they're not looking at the market at the time. They're slow. They're human. They may go to the restroom. They may not be able to capitalize and use that liquidity as counterparty. The market's still going to go where it's going to go after that. It has nothing to do with buying and selling pressure. It's just like Pac-Man. Pac-Man can only go as far as that maze will allow it, and it's going to go and collect the dots. And the whole time you're going around trying to collect that dot, you have the ghosts, which is intraday volatility. The retracements that you don't expect around the corner, you're going to get you. Sometimes you might get lucky and you get a power dot where it runs up there, you get invincible for a little while. That means it's running in your favor. But that doesn't last forever. You start blinking, just like the Pac-Man will. And that's your warning sign when you get that gorilla. You're beating your chest. You can't do anything wrong. You're going to make so much more money. You're going to be at the top of the FTMO board. You're going to be at the highest social equity curve across all the Twitter and Instagram. You're going to be the leader of the pack. When that feeling of invincibility comes over you, you're really technically blinking as a trader, like Pac-Man. You're about to lose your invincibility. And invariably, that's usually when the ghosts are on all around you, and you're crushed. So you have to be mindful that while these markets are scripted, and nobody likes to admit that, and the worst thing that can happen is someone in the financial industry that's done work in this field, they're usually the ones that are very critical of me. Very politely, though, but they're very critical. They're like, oh, yeah, the guy seems nice. He's got some good patterns, but he really doesn't know what the market's really doing or what's really going on. That's bullshit. The fact that I'm able to tell you what is going to happen beforehand and understand what this algorithm is going to do, that negates everything that you've been indoctrinated with. See, when you go to these institutions, these firms, and they train you, they groom you, or you read the books that everybody regurgitates, they're always telling you that the markets are random. These markets are all based on supply and demand and buying and selling pressure, and they're not. Think for a second, folks. Think. If that's really, really what's going on, why aren't we getting market crashes more frequently that absolutely decimate the financial institutions? It doesn't happen. It doesn't happen. They put in the circuit breakers that makes you feel like what? Oh, you know, they're staving off the buying and selling pressure. No. They're giving you a false sense of security, making you believe that the markets work on that. That's not what this is. These markets are going to book to these levels because that's where it's coded. That's it. That's all it's doing. If you don't participate in the move, it doesn't matter. It's still going to go where it's going to go. It doesn't need a lot of volume, a lot of buying and selling to rebook it to a level that I'm teaching you. These price points are going to be delivered because the algorithm has been coded so that way the liquidity that would be resting there, it is unknown to the algorithm how many contracts are there. How many buyers are above an old high? How many sellers are below an old low? It has no way of knowing that. It doesn't have that ability to see that, but it need not know it. It just needs to reprice up there or below it. And the traders that know and understand liquidity, the counterparties that exist at that moment in time, as soon as the price goes above that high, those buy stops are triggered and they become what? Market orders to buy at the market. You only have so much time before it reprices away from it, higher or lower. So as soon as it goes above that old high, those buy stops become market orders and floods the market with willing buyers to buy at a higher price. Well, that's advantageous now, isn't it? Because if the composite man says, I know that this is most likely to rebook lower for this sell side, I really want to be in front of my charts when the price gets to that level there, and I want my orders in. So they're putting their sell limit orders up there in that pool of liquidity of buy stops. Or they're engaging it live. As it's going up there and it runs above that old high, those buy stops become a flood of market participants willing to buy at a higher price. Done. Big surge of liquidity. Blah, 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 blah. Whole bunch of stuff comes into the marketplace, willing buyers. And if you can get your order in and pair up as a counterparty, as a short to that buy stop, just like the composite man does. Then he sits back and he waits for new opportunities to engage it as it works towards that lower level discount, that 40, 29, 50 level, and the liquidity resting below it. They don't freak out every time it rallies up. They don't think, oh no, that harmonic shark back pattern got my ass again. They're not thinking about any of that stuff. It's mythology in trading. There's no wave counts to consider. There's no diagonal trend lines to worry about having them correctly annotated on your chart. It's submission to what? Time. Time. You have to give it time. What time is it right now? It's 11 o'clock. It's London close in Forex. So that means what? The composite men that work in that time zone are getting ready to close up shop. Then it's just the New York boys. So we do what? We do range-bound consolidation, retracements in the lunch hour. No, the market doesn't take a lunch, but the algorithm has been coded to allow for that. That lunch hour can create a consolidation that results in a continuation after lunch. Or it can just go consolidation and just that's it. We book the entirety of the day. Or it can go into retracement after a consolidation. Remember where we are right now and how far away we are from that new week opening gap, from Sunday's opening, from Friday's closing price. How's the market delivered? To the sell side we were looking for. Was it a clean price run? Nope. It's a lot of give and take, back and forth, back and forth, back and forth. So this is what? This is a high resistance liquidity run. Even though it traded where we thought it would go, even though it went to the sell side liquidity pool and discount level of 40.2950, it's done so with a lot more retracements back and forth. Every retracement. And some of you don't recognize it. And you just think, well, this is normal. It's normal in certain respects, yes. But what we're looking to do is trade these one-way rails. Just boom, takes off. It doesn't want to waste any time. You're in there and it rockets away and runs right to where you're wanting to go. And there's people out there that are going to say that you can't time the market to do that. That's bullshit. That is grade A bullshit. They can't do it. They've never met people like me. They've never been trained. But when you see it and you taste it, oh, something different. There's something different about all this. It's empowering. It's encouraging. And it removes the ambiguity of nonsense. Things that's going to distract you and take your mind away from time. You have to submit to time. If you're going to be trading the morning session and you think it's going to go to an objective of liquidity or something to the effect of a discount, if we've watched the buy side be taken, and we mentioned how now because it's done that in the markets after the holidays, it could become what? A seek and destroy scenario. So it means our attention was taken to where? Sell side. We watched the other markets confirm that eventual breakdown. But you just can't just simply, oh, it moved a lot. What if it retraces? It will. It will retrace. It will retrace more than you want to see it do it because it's high resistance. Not resistance like it won't go higher in price. High resistance meaning that it will go lower, but it's going to be met with deeper retracements higher each time. And then all through here, this completely upsets everyone that maybe thinks that they want to be short, but they'll get knocked out there. And when that occurs, when this moment right here happens, that buy side liquidity pool that we outlined, that this is where I'm thinking I want to see the market draw up there. Even if the market goes lower, that's advantageous. Why? Because the composite man, I said this, folks, it's in the recording. You'll hear it when you play this video back. The composite man will accumulate short positions here with those buy stops and ride it down to 40.2950. Now, the takeaway from this is how you benefit from these things, okay? It feels good to see it deliver. It feels good to see it rebook and reprice the levels we're anticipating. That's wonderful. That's exactly what we want to see. But you, as a trader, when you look at this, your task is to determine inside of these price runs, after the fact, you want to relax. You want to look at your price charts and think to yourself, okay, looking at this right now, if you screenshot it right at this moment, matter of fact, just do that. I'll give you a moment to do it, those that are watching live. That chart is what you're going to annotate tonight. Print it out. Oh, but it's going to be a lot of ink. I don't care. This one specifically, I want you to print it out. And all the empty spaces over here to the right, over here to the left, and up in here. You want to fill that in with your observations from today. At the moments that you heard me talk about certain things, and you want to do that by watching the video again. But that's another hour and a half or so. So what? You don't want to invest an hour and a half more to understanding how to do this when I no longer am going to do it with you. But you'll go out and work 40 hours making next to nothing and let someone else tell you when you can take a vacation and prostitute your time for whatever they're willing to pay you. You're willing to do that, but you are not willing to do the work that's required here, which is what I'm telling you is going to require for you to be able to do this independently without me. This ain't a perpetual hand-holding session. You want to take advantage of it. Look at this delivery today. Observe what you see in hindsight. Go through the chart, annotate what you see. Then go back and listen to it again. And pause when you hear me refer to things. And if I talk about another chart or if another market, if a certain time frame, go back and look at those instances as well at that time. And then annotate what you see in that chart, in this chart here. The dollar index was failing to make the higher high right here. What does that mean? Look at this chart. What pattern exists at that time? What thing that I did, what PD array, what instrument of engaging price as an entry, which one is at that moment occurring? And when you're done, the ones that make the most sense to you, consider that going forward. The one that makes the most sense to you, that you can see easily. It doesn't feel like it's a stretch to trust it. It's there for all of you. In this market delivery today, it's there. But for me as an educator, trying to press all of you into a mold, it's only this way. Sometimes my dialogue makes it sound like this is the only way you can make money. No, I never said that. But this is the only way you're going to get as precise as you can ever be. Consistently. And know. The next best thing to absolutely knowing the future, and it's going to absolutely deliver perfectly every time, there's nothing closer to this. You're not going to get any closer than this unless you know. And you're not going to rub elbows with people that know like that more than you're doing right now. And it will repeat every day. It'll happen. And over time, your observance of these specific things that you feel strongly about observing in price, that you keep looking, the thing you keep looking for when you go into the charts, what is it right now? It might not be the same thing come November. And you need to be flexible with yourself. I'm being flexible as your educator. I'm allowing you to bring your own personality to this. What instrument you trade with ultimately, it may not be ES. It may be a currency. It may be a stock. It may be a bond. It might even be a crypto. I'm not co-signing that, but I have traders that I've trained that are doing well with it. But while we're together, it matters not what instrument. We're going to use the same. That way everybody knows the same measurement, the same high and the low. Everybody has the same chart, and we're all focusing on the same thing. That's how you learn properly. And it also allows me to focus and keep my wits about myself because I get easily distracted and chase cars. So, anyway, I believe today was fruitful. I believe that we walked through a very important element to trading, expecting difficult sessions. And let me give you a contrast, because I know some of you are probably thinking, well, what does he mean still? I don't understand the high resistance, because this looks like it was an easy run. It wasn't an easy run, because if it was easy, you'd be short. You'd have your entry points, and you would have known beforehand, and there it was. What makes it high resistance is the fact that we had so many after the buy side liquidity taken here. Your chart should have this level here and this level here. Those are the two buy and sell envelopes in price. The algorithm goes higher up here to do what? Allow all the buy stops that were resting above these highs here to become market orders to buy at the market, which is what exactly I'm training you to look for. These are the easiest points of reference. If you're bearish, you want to go short in that. It feels scary, I know. If you're long, you want to be selling to those buy stops right when it trades into it, which is how I teach my 2022 model. You're engaging price to deliver and throw out your sell orders to willing buyers at a higher price. You're tossing it like horseshoes. You ever play the game Horseshoes? You're tossing your orders to exit in this area. The pole that you're throwing that horseshoe at is here. So when it drives up into that, whether it's a limit order that's waiting to be filled, or if you're going to market it, it's a manual exit. Either way, the mechanism is still the same. You're trying to get close to that old high back here. There's nothing wrong with getting out of it a little bit before it. I do a lot of times. Do just that very thing, because I have been doing this long enough to know that, because I'm so obsessive about being perfect, the way I combat that, because sometimes, and you watched this a week ago, where my limit order was the actual high tick, and it never allowed for the bid and ask difference to fill it, and it came back and rolled on the one contract I had remaining left and stopped me out, which was fine. There's no big deal. It wasn't a loss. It still was a profitable endeavor, but it still communicates what? You have to balance your expectations in terms of precision and be practical with it too. So is it wrong for you to want to close a long position before it hits this area here? No, there's absolutely nothing wrong with it. If it's above your entry point and you're long and you're exiting, whether it be a partial or your whole profit, who's going to tell you did it wrong? You made money. You have more than you had before you started. And someone's going to tell you did it wrong? No. Wrong would be letting it go to a stop out where it was a loss. That's how it's wrong. Wrong is not paying a partial, because they win every time. Every time they win. Real quick, dollar index is still inside its range. It's pulling back up into the midpoint of its consolidation. Let me draw a chart real quick. Small little gap in here. If we can stage a rally above these highs here and continue, we could really be in. We could be in for a big down day in equities. That's not to say it's what's going to happen, but if we get above here, that could really set the stage for a pretty important sell-off. Large range day down is what I'm referring to. Not on dollar, but with ES and NASDAQ and Dow. Let's check out NQ real quick, and then I'm going to close this one. All right, so earlier today, I mentioned how the NASDAQ had yet to make its lower low in concert with the S&P and with that of the Dow. I took your attention in here to these two wicks, and it was happening pretty quickly, so I know that you probably didn't appreciate or could appreciate what I was trying to draw your attention to. If you ever have, this is for your notes, and again, you'll see these things form in your back testing, and you also see them form going forward as well. If you ever see a big down candle like this, what makes it big? Look at the candles before it. Relatively speaking, this is larger compared to this one here, right? And all these over here. So there's a lot of what? Displacement to the downside. Is there a fair value gap in this? Not on this 1 minute chart, it isn't, no. Nope, it's not. But look closer. Real time, I try to take your attention to it, and I know it's in the recording when you play it back. I told you to take a look at this wick here and measure it, eyeball it, find the consequent encroachment of that wick, and in the consequent encroachment of this wick. I'm going to show you what the algorithm's referring to here. Okay. Between the consequent encroachment of this wick at 12,264 even, and the consequent encroachment of this wick here, which is 12,248.25, that right there is equivalent to what? A fair value gap. Oh my goodness. Oh my goodness. We're getting to the good stuff. Not yet. It's getting better as we go. So this price point here, right? I'm trying to I know this thing likes to jump right to I'll draw it away from it. We'll get close to it that way. Okay, and then this one has to be on 258.25. Right there. So right there is equivalent to a fair value gap. Now you don't see it. You don't see that in the charts. And when I talk about things that are not in the chart, this is one of those things that that signature is referring to. What can the wicks do? Color outside the line. That's where the damage is done. Outside of this implied fair value gap, because that's what this is, making sure it's in your notes, label as such. We don't have a separation because if you look at, I'm going to extend this over so you can see there is no distinction between this candle's low and this candle's high and only having this candle's range noted like a typical fair value gap would show. Both of these wicks overlap each other and offer no gap on this one down closed candle. But because we have two long wicks, this here on this candle, and then we have a long wick or tail on this candle here, you split that in half on both of them. And you use both consequent encroachment. Now, imagine me trying to teach this tonight. Okay? Say you didn't watch me refer to it live. I never mentioned it, never drew your attention to it live, and I opened the comment section up. I guarantee you, I'd put $10,000 on it. I'd probably have 50 people say, this is cherry picked. This is all conjecture. Nobody would have been, you couldn't have said that was going to happen because you never saw it in a book. Nobody's ever talked about it. But I took your attention to it live as it was happening. Now, with the benefit of knowing what it is that you're supposed to see in it, look real close. What do you see? Isn't this just like a fair value gap? You might get a little bit of a mohawk above it, okay, because you want seamless price delivery. Where does it really go to? The order block. What's the opening on that? 12, 268.5. What's the high on that candle? 12, 268.75. One tick into it, this order block. Then the bodies are what? Where are the bodies forming? You want to know what I'm looking at when I'm reading price, when I'm looking at fair value gaps, institutional order flow, entry drills and things? The benefit of knowing where the bodies stop. Ready? Midpoint is here. Did the bodies even reach and touch the consequent encroachment of this implied fair value gap? No. So it's doing what? The bodies are telling you the story. The wicks are the damage. Okay, it's always going to go outside the lines. But the bodies of these candles are telling you and indicating that it can't even close or open on a new candle at the midpoint, which is consequent encroachment of a imbalance. Even though this doesn't look like it's an imbalance, I'm teaching you what the algorithm is seeing at that moment. What levels is it going to refer to? The midpoint. But if it's saying, no, I'm not going to rebook there, the composite man sees that as a signature to say, okay, we are decidedly weak. Now aim for sell side. Because even though the wicks went up there, retail sees this stuff, while it was a bold-faced candle, bullish, they're going to trust it's going to go higher. Go back and listen to the recording at this time right here. I said this is where you want to see NASDAQ come up here. Watch these two wicks, the consequent encroachment on both those wicks. Watch that because it's going to want to do what? Catch up with the lower low that was formed in ES and a lower low in Dow. So your setup would be where? Even though we're not trading NQ, I said this is how you would use this and study this one. And it did exactly what we said we were going to see, lower prices. But the fact that the bodies were unable to book at consequent encroachment, which is the midpoint of that range, that was the signature that you're not seeing in books. Elliott has no idea of it. Gann has no idea. Wyckoff had never heard of it. Supply and demand, no, nothing. None of that stuff. The fact that it failed to get to that level when it's likely to go for sell side below this low here, make a lower low, when everything else in the market was indicating it should do it anyway, your eye goes right there like I'm teaching you like mine does. It should have what? It should have went up higher. And if it did, then I would have to wait for another subsequent fair value gap to indicate what I'm showing you here. The fact that it can't reach up to a level that it should reach, which is midpoint, it's showing you it's exceedingly weak. Even though the wicks did this, I am not tripped up by the wicks. You're going to hear that all year long. The wicks are going to distract you. They write books about those things. This is a doji. Look at this here. Look at this length of this doji versus this length. That's all conjecture. The markets are not booking on the length of these wicks. Consequent encroachment, or 1/4 of that wick, it is. The equivalent of this not reaching the midpoint and indicating to us as traders that it's decidedly weak is indicated in the same way we looked at with the dollar index. Think of that level as the midpoint of the implied fair value gap that I was just showing you in NASDAQ. Conceptually, just think of it as the same thing. Like this is what it would be. And it went up real close to it, didn't it? But then it stopped. Well, the fact that it couldn't get there is what? Failure. So if it's going to fail to run this, what is it likely to do? Go the other direction. But if you already have an inclination that it's going to go the other direction anyway, which is what I was tapping you real time, saying, look, NASDAQ is going to form it next because it's right now it's the leader, but it will fall sick. It'll become ill and fall to the same plague that caused the NASDAQ to rally against, where Dow and ES went lower, made a lower low in a day. It had already made lower lows. NASDAQ hadn't done it yet. So it's going to be playing keep up with the Joneses. It's going to hurry up and run, try to catch up and bring back symmetry to the marketplace, when at the time, NASDAQ was not showing market symmetry. So much like this here is failing to get to a buy-side liquidity pool, where did it really fail at? Where's the bodies? Look at the close on this candle, and where's the open on that candle? Where is it occurring? Consequent encroachment. What it does not do in price is many times much more important than what you see it do in price. The things that are not in the chart, that's not drawn to your attention with books and courses and nonsense, that's the stuff that's going to creep in and you're going to fall victim to it. And I'm teaching you how to see it, anticipate it. And when it forms, it gives you greater insight about where the price is going to be delivered later on. You're predicting the future with things that you can't find in books. That should get you jacked up. You should be all vibrating right now, because this is stuff you ain't supposed to know. You ain't supposed to know this. And it happens every day. And now you know what it looks like. You can go back through your charts and your jaw's going to drop. It's been there all this time. And no one's ever told you. It's fun. It's fun, isn't it? So anyway, let's take a real quick look of Dow. You guys created a monster with me now. I didn't want to do these live streams. Now I don't want to stop them. Don't stop them, ICT. We don't want to see you stop. So here's the Dow. So again, much like I was mentioning earlier, it's a high resistance liquidity run. Yes, it will go to our objectives. Yes, it'll get down there lower. But look at the retracements that come back. When you have a high resistance liquidity run, write this in your notes. High resistance liquidity runs will see and have more likelihood of short-term stops being rated. And that in itself is how you would trade a high resistance liquidity run. What do I mean by that? Above this short-term high, what's above it? Buy stops. It runs it. Then price does what? Reprices lower. Okay? Short-term high here, we move away from it, comes back up into an imbalance, bear shorter block trades, goes lower. This run here, what is it really doing? not only is it taking into account this imbalance here and repricing and rebooking to offer fair value to the market that wasn't offered efficiently here in this one drop down, it's returning back to this order block. And all this sell side that was not efficiently delivering what buy side, the market's going to do what? Offer it on the upside. At one time, this candle was bold-faced green, bullish, to the point of coming into this area here. But not only was it doing that, it was doing something additionally. Right there. Right above that short-term high. Trailed stop losses on anyone short because they're afraid. They don't know what you were told today. They didn't know about that 40, 29, 50 level in S&P. They didn't know how to read the other markets and trust that it was going to gravitate towards these sell-side liquidity pools. But they're afraid that they're going to lose. And they jam their stop loss up right behind where the market's trading recently. And you cannot do that. When you see my examples, I'm not doing that. I'm partialing out to teach you how to compensate for the fear of not doing that. You're trying to avoid losing. That's what you're trying to do when you first start trading. But you have to welcome losing before you learn how to trade, because that's where the real learning. You're going to see where you're going to make the mistakes. If you do this the right way, you will see where your problem areas are. You're impatient. You're impulsive. You're a gambler. You chase. You're too slow to act. You're lethargic, in other words. Don't hide from that. This is what you want to learn what your weaknesses are right now while we're doing this, because you'll be able to provide coping mechanisms that will help you gravitate away from doing those things and replace those bad habits with positive ones. But in a high resistance liquidity run signature, you see a lot of this coming back for short-term stops. And then it still keeps going lower. But every time when you're a neophyte and you don't know what you're doing and what to expect in price action, every time it runs above these short-term highs, it's going to feel like what to you? As a student of me, oh, it's a shift in market structure bullish. No, it ain't. No, it's not. And that's why all these yahoos out there that have been writing books on Amazon with my stuff that don't know how to do it, they're leading people down the primrose lane, and you think that you are seeing something that you aren't. And then you're discovering when you get out there and try to use that abbreviated 5-minute trainer version of what I'm teaching you, it doesn't work. But funny that when I'm out here, it's working for me. And I'm going to teach you the correct way of doing it. I'm going to teach you by the numbers this year. You will know exactly what you're supposed to be doing and what not to be focusing on. That's proper mentorship over live candlesticks. No safety net. So I think that's going to be it for this one. I think we've covered a great deal of subject matter for one day. And I believe it's time for brunch. I need a meal inside of me now. So if you had fun, if you've learned something today, if you enjoyed it, give me a thumbs up. That's like rocket fuel for me. And if you didn't, tell me what you wanted to see rather on Twitter. Give me some feedback there as well. And until I talk to you next time, be safe.